Okay. BIM. Folks, Nick Musunda here, video number 4, talking about trauma insurance in this one. What is it? Why would anyone get it? So yeah, if you've got trauma insurance or if you're considering getting trauma insurance, this may be of interest to you. I wanted to start by sharing a story which I heard recently, which is pretty remarkable, from a surgeon. He was talking about how if you had severe diabetes and got gangrene in a limb, then he may end up having to cut that limb off. So that in itself was pretty remarkable, but the crazy thing was that even after having their limbs cut off, he said that he had patients that would continue the same behaviours that got them there in the first place. In other words, they'd continue to eat sugar, processed food, drink Coca-Cola, whatever it might be, even though they've been told unequivocally if they stop, their diabetes would reverse, right? So that's pretty crazy to me. But the reason I share this story is, one, because severe diabetes will pay out if you have a trauma insurance policy, but it's also just a sort of out there example of of the limitations of human will, I guess. And you know, you never know what's going to happen in the future, but sometimes you do know and you still can't do anything about it, right? Okay, so look, trauma insurance. I'm going to cover off about 8 key points in this video. So let's get into it. The first one, what is trauma insurance? So trauma insurance goes by a few different names. So critical illness, serious illness, crisis recovery, living insurance. These are all names of the same thing. So it's a policy where if you get ill and you meet the diagnosis criteria in the product disclosure statement for that insurer, then they pay you a lump sum of money. And that's a tax-free lump sum of money that you can do whatever you like with. Okay, so that sort of covers off the second point, which is how do you get paid? Now, I just want to clear up a misconception here as well. Trauma insurance policies, despite the name, don't cover you for injuries, right? So no traumatic injuries are typically covered. Typically, there are exceptions to this, but usually people will take out trauma insurance because they want to cover off illnesses, right? So the exceptions might be, you know, loss of permanent use of a limb from an injury. You can get a payout for that with some policies. If you permanently lose your independence from an injury, you can sometimes get a payout for that as well, depending on the policy. But typically it's heart attacks, strokes, cancers, diabetes, autoimmune disease, degenerative disease, neurological diseases. These are the kind of illnesses that are usually listed on the policy. You usually will have 40 odd illnesses if it's a retail policy, not a direct policy, which I'll touch on a bit later in the video as well. So point number 3, or question number 3, why would you get trauma? Okay, so I want to basically talk about a little bit of data here quickly. So I'll put some of this up on the screen, but basically if you look at the top 5 causes of death to Australians. Now, just to be clear, trauma insurance doesn't pay out when you die, it pays out when you get the illness, when you get diagnosed with the illness. But this is just to show you what is leading to people's deaths, to give you a sense of how common these illnesses are. The top 5 illnesses that you can see there, hopefully I've got them up on the screen, are, with the exception of COVID-19, because this was last year, 2022, they're all these sort of degenerative illnesses. Heart attacks, cancers, cerebral vascular issues like stroke. They're the kind of things that are killing people. Now, if you look at cancer and heart disease and the mean onset age, it's usually going to be like in your 60s or maybe early 70s. Okay, so that's when people usually get diagnosed with it. But obviously it could be earlier, it could be later. Okay, so that gives you a feel for how common these illnesses are and a bit of justification for why you might want to get a trauma insurance policy. And now another misconception is trauma insurance, because when I used to sell insurance, advise on insurance, when I was working for TAL, a subsidiary of TAL, I got asked this all the time. Isn't it like health insurance? Like, I've got health insurance, I don't need that. Okay, it is different. With health insurance will pay out to help you cover the costs of your medical expenses for treatments that are listed on the policy. And it may not cover all the costs. There may be a gap, okay? But you're definitely going to be limited to using it on treatments that are listed on your health insurance policy. Whereas with trauma, if you are successful in getting a claim, you can use that money for anything. You can use it on medical expenses. You can use it to pay off some of the mortgage. You use it to offset your lack of income if you're not working because of your illness. You can go on a Hawaiian holiday if you want to. You can literally use the money for whatever you like. So that's a key point of difference, and just a basic point of difference between health insurance and trauma insurance. Okay, so how much cover do you need? So how much cover you need this is very subjective and kind of contentious, I guess, maybe. Because it is so subjective, every man and their dog probably has an opinion on how much trauma insurance is required. Now, if you go and get advice on trauma insurance from a financial advisor or maybe an insurance advisor, they're going to have some sort of model or needs analysis that they do, which is going to spit out the figure that they suggest you should go and apply for. Okay, but really the predictive power of these models is, I don't know, not that great in my opinion. Like, it's probably just as valid to go and use a rule of thumb of taking 1 year or 2 years worth of your income. Okay, it's probably just as valid, right? No one really knows what's going to happen in the future and how much money you're going to need at that time. So the main thing is that you get yourself a reasonable cover amount to go and use to get quotes, because once you get the quotes, you'll be able to see how much costs you're up for, and that'll immediately give you that feedback, and you can go, hey, I think this is worth it, or maybe this is too expensive for me, I need to reduce my cover amount, etc. You can start turning that knob and narrowing down to a figure or a cover amount that you're comfortable with and a cost that you're comfortable with. So that's a couple of points covered there in and of itself. How much cover should I get and what should I pay? The market will tell you when you go and get those quotes, right? So that's 5 key points. Sixth point is just an observation. Look, trauma insurance is not very common in the market relative to other personal risk insurance like life insurance or death insurance, same thing. Total and permanent disability insurance, income protection. I think the value proposition for these policies is a little bit clearer than trauma, and obviously, well, this is obvious to if you're in the industry, but trauma insurance is not available through superannuation. So because so many people get their personal risk insurance through their super, and super funds can't offer trauma insurance, not many people have trauma insurance. So that's another key reason. But I do notice that people with more disposable income are the ones that will typically take out trauma insurance. Maybe they're a little bit more pragmatic about their likelihood of getting diagnosed with some of these illnesses. But yeah, people who have less disposable income, they're not going to have trauma insurance, most likely. That's what I've noticed. Okay, so that's the 6th point. 7th point, this is retail versus direct. I mentioned I was going to talk about this. So retail policies, just to give you a little bit of background, are policies that you can take out which are designed to be bought through an advisor. So the advisor would be giving you some general advice or some personal advice about the cover, and then you would make a purchase. Direct policies are designed to be sold directly to the consumer. There may not be any advice given, or there may be some limited advice given, some general advice given before that person takes the direct policy. So they're just sort of like, direct policies are sort of like a pre-packaged, ready to go policy. Now, one of the key differences that you'll find between retail and direct is retail policies will have 40 something illnesses that they pay out for, whereas direct policies, you're probably going to have like 4 or 5. Okay? You may have more than that. You're going to have to check the product disclosure statement to find out conclusively, but that's typically what you'll find, and that's obviously a significant difference. So, when you've only got 4 or 5 illnesses that you're covered for, that leaves a lot of room for getting ill and not being able to claim on the policy. So it's something to take into consideration. Okay, so that's most of the practical stuff covered off. Last point, 8th point that I want to talk about, if you want to nerd out a little bit with me on insurance, I want to talk about the distribution of risk amongst insurees in a pool of insurees, right? So when an insurer offers a trauma policy, they're going to have a pool of clients that have the cover, okay? And there's going to be a spectrum of health and likelihood of claiming, starting from super healthy and risk of claiming being 0, all the way up to super unhealthy, where risk of claiming is 100%. Okay, now if the insurer will most likely establish through their underwriting process that if your chance of claiming is 100% because you're so unhealthy, then they're just not going to offer you a policy. Okay, but the interesting thing is that from perfectly healthy moving up in risk of claiming, you all get what they call the standard rate. So there's a bracket of risk where everyone gets the standard rate, even though the people up this end have a higher chance of claiming than the people down this end, right? Moving this direction in terms of health. I'll put a schematic, diagram up on the screen so this makes a little bit more sense. But basically, up until that point, everyone's getting the standard rate, and then there's a point where the insurer establishes and draws the line that if you're any riskier beyond there, they're going to charge you what's called a loading. So usually the lowest loading is 50%. So basically you go from having the standard rate on this side of the risk, of that line that they've drawn, you go from having the standard rate to paying 50% more, roughly. Okay. Now, what the interesting observation here is that if you're a gambling person, you're looking at this bracket where people are paying the standard rate, and you're going, this person is the highest risk, but they're getting the same rate that this person over here is getting, who is 0 risk of claiming. This person over here is getting the best value out of anyone, right? And the person who's 0 risk of claiming is basically getting 0 value. So it's an interesting observation. Now, the reality is, in practice, you don't know exactly where you lie on that spectrum. You don't know exactly what's going to happen in the future with your health. But nonetheless, it's an interesting observation, if you like. But yeah, I guess for the people that are really invested in their health, if they are super healthy and they believe their chances of claiming is super low, that's something that should be considered when they decide what they want to do in terms of how much cover they want or whether or not they should take out a policy. But look, that's pretty much it. That's trauma insurance in a nutshell, guys. Thanks for watching. Hopefully you got something out of that.